they're probably going to go back to QE.
You think so?
Look, in March of last year, we would have had a worse financial crisis than 2008 had the Fed not stepped up. Now, that doesn't mean they did the right thing. They did the wrong thing. They should have allowed the crisis, because a worse crisis is going to result from the delay and what they
another
did.
worse crisis is ahead of us than 2008.
Yes, and worse than what March would have been last year had we had it in March of last year, right? They always kick the can down the road because they'd rather have a problem tomorrow, even if it's a bigger problem tomorrow, than a smaller problem today, because then it's somebody else's problem, right? But I think the banking system is completely insolvent in the United States. I think it is in much worse shape than it was in 2008 when it collapsed. And usually people will say, well, yeah, there's problems, but it's not like 2008. But they think it's not like 2008 because it's not as bad. It's actually not like 2008 because it's much worse. So there's two big real estate problems, or problems the bank has. In 2008, the problem was mortgage loans that went into default. People stopped paying their mortgage. And the reason this was a problem for the banks is because when somebody doesn't pay their mortgage, well, you got to sell the house. That's the collateral for the loan. But if you remember back then, people were making zero down loans. And so they didn't have much. And real estate prices went down. So I loaned somebody $500,000 to buy a house. Now the house is worth $300,000. The fact that that's happened in and of itself is an incentive for the borrower not to pay.
Of course, walk away. Yeah.
And especially if they had a teaser rate on their mortgage. So their mortgage started out and the guy was paying maybe $2,000 a month, but now he's paying $3,000 a month, but he only makes, $2,000 a month, whatever. He was paying a lot of money for his mortgage because he thought he was going to get rich owning a house. When it turns out that he went broke, he's not going to make that payment. Why make payments when you're so underwater?
I mean, that sounds worse than it is today, where you've got people locked in at 2.5% mortgages, 30-year.
No, it's not worse. It's worse for the borrower. Although the borrower just walked away. If they put a down payment, they lost it.
In 2008, they just walked
away.
Okay.
But you could go and rent a place or do something else. Mm-hmm. So the problem was when the loan defaulted, the bank lost. And when I was critical of the adjustable rate mortgages and nothing down and things like that, I never criticized it from the point of the borrower. I always said the borrower was smart to put nothing down because then you got nothing to lose. I mean, if somebody is dumb enough to let you free roll, right? Putting a down payment was the mistake. The problem with a zero down or low down, no doc, ARMs was the lender. The lender was giving somebody, a free bet on real estate.
So
hey,
why
I'm going
not
to buy
take
this
it?
real estate. If heads I win, tails the bank loses. Well, it was tails. The banks lost. And so they lost money. And, a lot of banks should have failed. And unfortunately, they got bailed out by the government. But most mortgages did not default. It was still a small percentage, but that was enough to wipe out the bank capital because they didn't have a lot of capital. It was big pyramid. Well, today, it's the opposite problem. The problem isn't the mortgages that default. It's the ones that are current, that keep paying. Because this time, real estate prices haven't crashed. The mortgage prices have crashed.
Huh.
So
the bond market essentially has crashed.
So the homeowner doesn't own the mortgage. He owes the mortgage. He owns the asset. The bank owns the mortgage. The mortgage has crashed. So if I loan somebody $500,000 at 3% and they don't have to pay me back for 30 years, what's the present value of that mortgage? Oh, maybe, 30, 40%, half. Mm-hmm. So the banks are underwater, not on the real estate, but on the mortgages. Now, the borrowers, they're going to pay. They're not going to stop paying on these sweetheart deals. They got 3%, right? They're going to take that mortgage to the grave. Right? It's the only thing that's not going up, right? The price of everything is going up except your mortgage, right? So The mortgage is the homeowner's biggest asset. It's the bank's biggest liability. So the banks are losing money on every mortgage, and the homeowners aren't going anywhere. And they even if they wanted to, they can't. They can't sell because they can't buy anything else because they can't get that mortgage. The mortgage isn't portable. They can't take the mortgage from one house and move it to another house, and the buyer of their house can't even assume that mortgage. So they're stuck there, right? So the real estate market's not moving. Houses aren't for sale, so home prices are still high. No one could afford to buy because the price is structured for 3% mortgages and they're 7%. So the housing market is dead. But so the banks have lost a ton of money, but it's not just mortgages they bought. They bought treasuries and things like that, so they're way underwater. That's why the banks can't afford to pay interest. Go to your bank and say, hey, how much interest can I get? Well, I can't get anything. Oh, then I want my money. I'm taking my money out of your bank. I'm going to put it in a money market where I can get 5%, right? That's the crowding out. Everybody's loaning money to the government. The banks don't have any money. That's why the banks had to go to the Fed. Why did the banks need money? Because the depositors wanted their money and the banks didn't have it. Well, they still don't have it because they gave it to the customers. How are they going to repay these loans in March? That's why I think they're going to extend this program.
So you think the only way essentially the Ponzi keeps going is if the Fed extends the bank term funding program, and if they don't, and they call these $160 billion of loans due, we'll have banking crisis 2.0. What does that do for the consumer?
Exactly, but also depositors. If the Fed doesn't extend this, that's going to create a bigger run on the banks because you're going to have to take your money out of a bank if you're worried it's going to fail, because the FDIC only goes to what, 250,000 now. What is it?
Yep.
So if you've got a lot of money to bank, you're not going to leave it there. You're going to take it out and put it in one of the too big to fail banks. So any bank that's not too big to fail is going to fail. That's another example of where the government comes in and distorts the market because they give a comparative advantage to the bigger banks. But the other thing I wanted to point out about why the banks are insolvent, particularly a lot of the regional banks, it's not just a residential mortgage book, it's commercial. And commercial is a different problem. Commercial is more like 2008, where it's the default problem and the collapse of commercial real estate values. Because when people bought a lot of this commercial real estate, interest rates were at zero. And commercial real estate is like a bond. It trades at a cap rate, and the lower interest rates are, the more commercial real estate is worth. Because what investors just do is they look at the income, right? And they compare it, well, I can buy this piece of property and collect rent, or I can buy this bond and clip coupons. So it's the interest rate determines the value of the commercial real estate. So when interest rates were at zero, and you had rental streams from property, commercial property prices went way up. And that was also helpful because in 2008, when the banks were losing money on their residential loans, they weren't losing any money on their commercial loans because commercial real estate went up and everybody paid. But now what's happened? Well, you had COVID, and that started the work from home craze. So a lot of office space is empty. You also had the bankruptcy of what's that company?
Credit Suisse. The banks.
Sorry. No. The company that rented out all this office space.
Oh, WeWork again. WeWork for the second time.
WeWork, yeah. Yeah. So now you have all this WeWork space, right? WeWork didn't. That was my joke always about it. But now you have all that space on the market. Right? They were some of the biggest tenants in the major markets in the country. That space is up for sale. Interest rates have risen a lot, so that's also brought down real estate. But the rents have collapsed because the offices are vacant. Then you also have shopping centers, malls that are half empty. Why? Well, not only are people working from home, they're shopping from home. And they're shopping less because they're spending all their money on food, on rent, on utilities, on healthcare. They don't have as much money left over for things that restaurants or stores that they would just go and buy things that they don't really need, just stuff that they liked. So you have all these vacancies that have collapsed the income. So commercial real estate prices, you look at most markets, they're down 30%, 40%, 50%. And in some cities, where the crime has exploded ever since, we had the Black Lives Matter protest with Chauvin and George Floyd and all that stuff, when all the police just stopped enforcing the laws and they stopped locking up the shoplifters. Insurance rates have gone through the roof, losses due to theft. So stores are shutting down, and a lot of employers don't even want their workers coming to work. They're afraid.
So what do you think? How does this manifest?
These are huge losses for the banks, because the owners of this commercial real estate, when you borrowed, let's say you borrowed $200 million from a bank to buy a piece of property, and that property is now worth $100 million, and your loan was 7 years and now it comes due. And when you borrowed the money, you were paying 4%, and now they want 10. I mean, what's the odds that you're going to, even want to stay in? No, you're going to mail in the keys. You're going to give the bank back the building. Better give them a $100 million building than a $200 million cash. So the banks are looking at massive losses on their commercial real estate. At the same time, they have massive losses on all their residential mortgages and government bonds. So the whole banking system is completely insolvent. And the Fed hasn't even raised rates anywhere near high enough to get rid of inflation. We actually need much higher rates than where the Fed stopped. And not only do we need the Fed to tighten more. Oh, I forgot I had my phone.
It's all right.
Turn that off.
So let me
finish this. But not only do we need the Fed, right? Not only do we need the Fed to tighten more, we need the government to tighten, because you need contractionary fiscal policy as well as monetary policy, right? You can't have one without the other, because the engine of inflation is the government spending more than it collects in taxes, because you're putting artificial demand into the economy. Now, it's worse when it's monetized by the Fed, when the Fed is printing the money to buy the bonds that facilitates this extra spending.